Welcome to the Increda-dental podcast. I'm your host, Alicia Flynn. Our goal is to make a positive impact in the dental field. I have been a dental assistant, a biller, an office manager, a scheduler, a hygienist, and a dental coach, which makes me your biggest fan. My husband was in the military and we traveled all over the United States. I had opportunities to work in many different practices, and I saw incredible practices and practices that had a lot of potential within them. Thank you for joining us. Let's dive into the podcast. Welcome to the Increda-dental podcast. I'm your host, Alicia Flynn. Today, we have a special guest, Stephen Nance. He is a CPA who specializes only in dental industry. So he does several in and outs that can be beneficial that you can apply to your office, to your team, to your practice today. And I'm super excited to have him on. And Stephen, I'm going to let you introduce yourself.
Thank you, Alicia. It's so great to be on your podcast with you today. I'm a CPA. I'm a partner at DrillDown Solution. We specialize in the dental industry. We do work with some small business clients as well, but our focus is on the dental industry. And I'm happy to be here.
Yeah, fantastic. All right, let's dive into a couple of questions that I have for you. Now, I understand you have been an auditor for the IRS. Tell me a little bit about that.
So I was actually an auditor for the state of Utah in their corporate tax department, but also my father was an IRS auditor. So I come from kind of a background of the regulatory compliance side of taxes, which is kind of the opposite of where I'm at now. So it gave me a unique perspective that I believe is helpful to what I do now and to my clients now, where I can look at an issue, a tax planning opportunity, and I'm not only going to look at the potential tax savings that I can help it with, but also I'm going to look at that from all angles of, if I were an IRS auditor, how would I want to look at that? Because the IRS auditors are not looking for ways to save you money.
And that's supposed to be shocked, right? Like, okay.
They are, I mean, it's their job to effectively do the opposite. They're trying to expand the tax. And so if there's ways to poke holes at something, I'm going to explore that and let my clients know of the potential risks as well as the benefits.
Oh, I love that, because of knowing what the risk is and then the benefit, you can weigh it better. Knowing the pros and cons is so powerful for someone in the dental field, and wanting to avoid the stress of being audited, but also get the maximum, or the minimum, tax payment that they want to take. So allowing them to have, and you allow them to choose those options and advise them in that. Is that correct, Steve?
Yeah. And when we're doing tax planning with clients, I don't think it's my job to dictate exactly what the client needs to do. You do this. My opportunity is to educate my clients and let them know what they can do. And I have a broad client base, and some of my clients are going to be aggressive and take advantage of whatever they can do to save the tax dollars that they would otherwise have to pay. And I have other clients that appreciate the information, and they are never going to take those big jumps that have any possibility of being, or maybe not any possibility, but any high risk they're going to avoid. And that's okay. I don't mind that if they're wanting to avoid those risks. But my clients always do appreciate the information regardless of what they decide.
Yeah, I love that you allow dentists to choose, and practice owners choose their journey, like choose the risk they're going to take, because that's powerful. Being advised, it's just like a lot of patients want a choice of what type of treatment, and we all love that option. So I think there's a lot of power in that, because then we know what we're going into. We're not blindsided, and that's really important. All right. So other questions we have. All right. What unique financial challenges do you see the dental professional facing right now?
Yeah, the unique challenges that I see dentists have specifically is the debt that they have. And that's a problem that's unfortunately not getting any better with higher interest rates and things like that. But it puts them in a unique position where coming out of dental school, people typically have hundreds of thousands of dollars of student debt just starting out. And then if they start or buy a practice, um, they're probably adding another $1 million, or in some cases more. That could vary quite a bit depending on the practice, but let's just call it 1 million. And then they're typically carrying some working capital debt, or if they're adding new pieces of equipment, updating their practice, they're typically adding debt, and that could be hundreds of thousands of dollars on top of that. So typically, a dentist is going to have a couple $1 million of debt that's in addition to the debt that all of the rest of us have. We have a mortgage, we have car payments, they have those too, of course. But then they have all this other debt. And that makes for a very stressful financial life. A dentist typically does better on paper than
Mhm.
the cash flow that they're actually seeing, because a lot of their cash flow or their revenue or collections is going to support debt. And it's also, if they own a dental practice, whether it's a single office or multi-practice, um, they've they've got to keep some working capital on hand in that practice, uh, for rainy day, to meet payroll and to service debt for next month. So their cash flow that they're taking home, their take home pay is very oftentimes a lot less than what the paper shows. And unfortunately, the tax law requires the taxes to be calculated of what's on paper, their paper
Oh,
profits. And
wow. Okay. I didn't realize that. That's interesting and scary at the same
yeah, yeah, because there's no tax deduction for paying your debt. There's no, other than the interest. And there's no tax deduction for keeping money on hand for working capital. You pay taxes on the
time.
profits, regardless of what's done with those profits.
Wow.
And so that puts dentists in a very difficult position with regard to taxes. And in addition to that, another nuance in the tax law, if you remember the Tax Cuts and Jobs Act that was passed a few years ago, one of the provisions it gave was a 20% tax deduction for business owners for their profits. You get to deduct 50 or 20% of your profits. But that doesn't apply to certain industries if their income is over, it's about 450,000. If they're high income, dental is one of those industries that they don't get to take that extra tax deduction that other business owners get to take. So not only are they in a position where they have a higher paper profit than what their actual cash flow is, they also don't get the same tax deductions that other business owners get. So they end up being in a uniquely difficult tax situation. And that requires a lot of planning and uh, and strategizing.
Yeah. So are there any, do you help them overcome some of these challenges? What kind of guidance do you give like a new graduate who's like $1.5 million in debt trying to start out? Like it's overwhelming and it's real. My heart aches for how much they're trying to accomplish and I love what they're doing, but I feel bad for how much debt they have and how they're swimming upstream and how stressful it is.
Yeah, it can be very stressful, and it can be uniquely shocking for that new business owner that has never had to deal with taxes like that before. And so once you own a dental practice and you start earning a profit, even if your take home pay isn't significantly better than it was before, but there's a profit that you start seeing, that the biggest thing is to start that planning process so that you can get a proactive look at it, because it often is sticker shock as a business owner. Once we start planning, and I tell my new business owner, dental practice, that if you don't do anything different, you're going to have to pay X amount in taxes, and that can be shocking. You don't want to get that news on April 15th.
No.
You want to have a year to plan for that.
Right. Yes. Yes. The sticker shock is not what we want. We don't want any more high blood pressure than we already have. We
Yeah.
don't want to have any heart conditions. Like being prepared for that and setting aside small amounts so that way that financial large amount is minimal is a good night's sleep.
Yep.
It's peace,
Yep.
for survival. So yeah, yeah, that's so true. So curious, being specializing in a lot of in dental, especially, what is the most often tax write-off that you see dentists miss? Because I see a lot of dental friends working and they have a CPA friend, and
Mhm.
but they're not specializing in dentistry, and I quietly worry that they're missing write-offs. So what do you see there? Because that's one thing that always raises my eyebrow.
Yeah. Yeah. And there is a lot of
Mm.
strategies that when I'm working with a new client particularly that people have never heard of. And it's very interesting that the word is just not getting out on some of these things. A couple that really come to mind. Some of these strategies is kind of a risk conversation that we go back to weighing that, how aggressive you want to be. And when I say aggressive, we're not doing anything, never pushing the envelope so far that it would be illegal, but aggressive meaning this has a chance that the IRS could look at this differently. And although it is legal, the IRS often takes an aggressive position too. But a couple strategies that really are slam dunk strategies that a lot of people don't know about, are one of them is state PTE elections. If you live in a state that has a personal income tax, which most states do, there are, Florida, Texas, Alaska, and in a few others that don't have one.
Washington, I think, is one of them.
Washington is one of
Yeah,
them. Yep.
yeah.
Um, but by far the majority of states have an income tax, and the vast majority of those states have passed a law that allows you to transfer your personal taxes as a business owner to your business. So your business pays the tax. And why that's significant, if we back up to the Tax Cuts and Jobs Act, one of the ways that they paid for those tax cuts is they limited your personal tax deduction for state income taxes.
Oh,
And
nice.
they limited it to $10,000. And that includes your property taxes. So if you're paying a lot of property taxes, you're probably getting little to no benefits for your state income taxes.
Oh,
So
not nice.
states, not nice, but states realize this. State legislature realize this, and they did a favor for business owners where you can make this election and pay tax at the business level, and state business taxes are entirely deductible as a business tax, and there is no limit. So now
Oh,
you can get the same benefit that you got before, and go on with life. But you've got to make the election. Every state has different rules around that election. But you want to pay those taxes through the business. If you're going to have to pay state income taxes anyway, you want to take advantage of that so you can get a tax deduction for it. The other one that I see overlooked that a lot of people don't know about is in regards to retirement. Most people are familiar with IRAs, 401ks. If you have a 401k, you can put aside 23,500 as an employee, plus you can do more as an employer match. You might be putting away 30, 40, even maybe 50, 60, 70,000 at most in 401k money each year, and that's tax deductible. That's a good benefit. But if you add another layer on top of that, it's called a defined benefit or a cash balance defined benefit plan. You can basically supercharge your 401k. And most of my clients that do this are able to put away well over $100,000 a year into their retirement account. And it's entirely tax deductible. And it's based on an actuarial analysis. So it doesn't work the same way for everyone. They typically work really well for if you're 50 or older, 50 or better, I should say. um, because there it's not a statutory limit on how much you can put away each year. It's targeting a defined benefit at retirement. So the closer you are to that retirement age in the eyes of the IRS, the more you can put away each year. And in some cases, people might be able to put away $200,000 or $300,000 a year, and it's entirely tax deductible.
So do
So
they
those,
get, yeah, sorry, do they get taxed on it when they withdraw because it's just tax deductible?
yeah, and that's a good
Okay.
point. It is taxable when you withdraw. Um, and so that is weighing because we don't know what tax rates are going to be in the future. They may be higher, and that is a consideration. But what you're doing is you're locking in a tax benefit now that's known. We don't know what the future is going to be, but you're getting a very good tax benefit now. Plus, not only that, that money is working for you. If you're not going to retire for 10 or 20 years, that money is growing during the time, and the stock market's been doing well in the last year, and who knows what will keep happening. But there's a lot of information to suggest that over time you're going to do well with your money, especially if it's being managed right by a good financial advisor. But though that growth is tax deferred, so
Okay.
in that 10-20 year period, you're getting the tax advantages not only from your initial contribution, but all the increases until you start withdrawing. And then you do pay some taxes. And by then, we don't know what tax rates are going to be in the future. But if you've sold your dental practice and you no longer have that active ordinary income stream coming in,
Yes.
then you can withdraw and you may be at a lower tax rate because you don't have the other income stream coming in. So I think they're a good thing. And it's a great way not only to get tax advantages, but diversify your nest egg. So it's not all in your dental practice, and you can get some diversification benefit that way.
Yeah, and I think that's so powerful what you're saying, diversification for your investments, because I've seen dentists turn around and expecting and hoping that their practice is their nest egg to sell and what they're going to retire on, and it turns out it's not enough. And
Mm.
that's really a sad story and a wake up call, but it is what it is. And by being diversified, it's just going to again help you with a good night's sleep. It's going to make sure that if something's not growing, something else is growing, and help you
Right.
to have that ability to retire when you're ready. So that's
Yeah.
a wonderful thing. So is there something that dentists can do throughout the year that can help maximize their tax savings, like quarterly things that they forget to do?
Yeah, for sure. But first of all, meeting with your accountant throughout the year.
Okay.
If you're meeting in December with your accountant, that's look. I have clients that's all they need, or want to talk to me.
Right.
Um, but ideally, we have a check in at least in the summertime, so that there's some data for the year where we can look at where profit is trending for the year, but then meet again in October and November. And that's when we finalize tax planning. So there's still a month or two left in the year to execute on any strategies. And then the other thing is to keep up on quarterly estimated tax payments. Those penalties have gotten to be a bigger deal a few years ago because those penalties are typically they're effectively based on interest rates. So it's called a penalty, but it's really interest added onto your tax because the IRS can't penalize you for not prepaying enough. They do, but it's really the due date is April 15th, but they want you to pay ahead of time. And so they tack on a little bit of an interest penalty if you don't prepay throughout the year. A few years ago, interest rates were really low. If people didn't make estimated tax payments, it didn't really matter. Maybe might have been less than $100 added to your tax, depending on your overall tax bill. Now those are significant. Though that estimated tax penalty is close. It used to be 2 or 3%. Now it's been hovering around 8%, and it fluctuates from time to time. But keeping up on those quarterly estimated tax payments can effectively save you money.
Yeah, we had the experience. We paid what we thought was the equivalent because we weren't on time filing our taxes, and we were underpaid by like a very small amount, $25 or something. And the interest we owed was equivalent to almost to the $25. And I was like, I was mad. I was mad that,
Yeah,
wait, this is ridiculous that we were this close and they're charging me a fee of like $19. I was like, oh, I wrote the check because I want to be honest with the IRS. I don't want them knocking on my door, but I was hot under the collar. I was mad.
Yeah,
I
yeah, understandable.
oh, that window. I was like, this is obnoxious. So I hear you. I hear you.
Yeah.
So yeah. So can you explain the Section 179? I've heard a little bit about this and how it applies to dental equipment because this is something that a lot of dental offices want the latest and greatest technology. And unfortunately, some of it ends up collecting dust. Some of it becomes vital to the practice. But how does that Section 179 help the practice?
Yeah, great question. I think Section 179, if you're not in the accounting world, is one of those buzzwords you might hear, but you don't really understand it. Um, so let's back up to what the general rule is without Section 179. When you buy dental equipment, and let's take for example a highly expensive piece of equipment, a CEREC or a chair, maybe $100,000 piece of equipment that or combined equipment purchases that you buy throughout the year. That $100,000, the you don't get to deduct that $100,000 in the year that you buy the equipment. It's spread out over a 5-year period. It's not exactly even each year, but it's over a 5-year period that you get that tax benefit. Section 179 allows you to make an election to take all that depreciation in year one. So if you finance that piece of equipment for $100,000, you may make very little payments that first year or no payments that first year. But you could take all the tax deduction in year one, which could really put you in a better financial position. If you utilize that tax savings in an efficient way, you can benefit by the time value of money, getting the tax savings now, even though you're going to pay for that over whatever the payment period is.
Yeah, that's kind of exciting, depending on where the dentist is and his
Yeah.
practice is. Like that has a lot of potential to really help them decide if it's a possibility to buy a piece of equipment that may be out of the price range for them, but also with a CPA to guide them with that
Right.
because it's easy to I've seen some practices buy 2 CEREC machines when it's like,
Yeah.
I don't know
Yeah.
if that was the best the best idea for the practice.
Yeah.
For
Yeah. And that's really a good point because you never want to spend $1 to save 40 cents. Right.
right.
Uh, and sometimes the timing of when we take Section 179, because we have options, or when you buy the piece of equipment, if you're getting close to year end, it might be better to do that next year. So that's part of the planning process as well.
Yeah, no, that's fabulous. Now, do you meet with your clients? You said you let them choose, but how often do they receive information from you, letting them know like how they're doing on a monthly basis or a quarterly basis? Like, how often do you advise them or let them know this is how you're looking, you're top heavy here or here, just so you know? Like, how often do you do that?
Well, first of all, we're always available for questions, but as far as the structured tax planning meetings,
Hmm.
ideally a couple times a year. So ideally, we're meeting in the summertime and again in October and November, where we're doing a full-on projection and going through the available strategies and coming up with a game plan. Two times a year is ideal for that. Sometimes it might be a few times a year. Sometimes it might only be once per year, but on average, I'd say the ideal time is twice per year.
Right. And if do you ever look at a dentist numbers and see like they're really high in maybe lab fees or in supply
Mhm.
or in paying their employees? And do you kind of just let them know I'm worried about this area? Do you give them some advice or just kind of guide them like just be aware this is high?
Well, most people, most dentists and non-accounting people,
Mhm.
when they see their financial statements, uh, they don't know really what to look for, right? And they might
Yes.
see net income on an income statement. And, okay, it's positive. Great, I'm making an income. Uh, but but we do point out on the financial statements, we have a quick summary that shows their percentages in lab fees, collections, and a few other metrics, and also what their cash flow is. Just a quick summary that highlights those key areas so that they kind of know what to look at and know if they're doing well and how they can gauge themselves against industry standards. And my role is typically on the tax planning side. So I don't really spend a lot of time in the weeds on those things, but we do offer that as a service.
Okay. Yeah. I just think I've seen some offices when we look over the P&Ls, they're way heavy in some areas and it's bleeding them. It's bleeding the business dry, the practice dry, and they don't know it. And
Yep.
that it's hard to correct that, but actually it's not that hard. It just is hard because it's different, because you're looking
Yeah.
at something differently and you're having that angle of how can I be more preventative in this area, right? We're all about prevention. How can
Yep.
I be more preventative in this area and to help my patients more, but also help my team more by doing slightly different things that make the practice more profitable, but also everyone wins in that step. So it benefits.
Yeah. Yeah, and that's a great point. When we talk about increasing your profitability, it's not just for you in a selfish way. Although, I mean, that's that's a benefit too. But your whole team is part of what you're doing, and you really can't do what you're doing without your team. And so the more profitable you are, the more potential you have to provide a great lifestyle for your team and be that great employer and create sticky employees, which is, from what I hear, a little bit of an issue, right? Uh,
just just a touch. Yeah. No, it is hard right now. And that's another thing that makes my heart go out to dentists, because I don't know if there's ever been a harder time than right now. Like there already was a shortage in hygienists and assistants back in 2019, but COVID just exaggerated
yeah,
everything.
yep,
And suddenly everything got worse. And it's not going to get better. I wish I could say it's going to get easier. It may get easier, but it's going to take an opportunity to become a better industry, a better way of doing things as a practice and as a business. So there's a lot of potential here to do better and to provide for owners to provide for themselves better, as well as their team and especially their patients. So there's a
yep.
lot of opportunity here. Anything we didn't cover that we should talk about?
Oh, I'm sure there was something.
We could go on for hours, right? So
Yeah. I mean, as far as tax savings and tax benefits, I mentioned a couple. Like I said, there are others that when I bring on new clients, or when a client gets into kind of that higher income range where we look at more advanced strategies that people are hearing for the first time. So I don't think there's a lot of information being shared out there. So if we got a couple minutes, I'll just quickly
yes,
a
absolutely.
few. I mean, one is captive insurance, and that's one of those where it could be seen as one of the more aggressive, or where there would be need to be a risk conversation. But the idea is you're setting up an insurance company to insure your business, your dental practice. And that can ensure a lot of things. It can ensure recare. A patient needs to come in, get a crown fixed, or any other type of procedure that you might need to do some rework on. But it's also ensuring the big things. If if um, if there's road construction in your area that really has an impact on the practice, which I have seen in clients, or if there's a political shift, or if there's another pandemic that could shut down your
Don't
business.
don't say it. Don't say it.
We don't want to think about that. But the fact is that there are risks that you assume when you're a business owner. Some of those risks you can pay a third party insurance company to handle the risk, right? And if it's for your business, generally you get a tax deduction for paying that third party for those risks. But if you don't have a claim, or if your claims aren't enough to justify your premiums, you're out the money. That
Right.
third party keeps the money. Or those other big risks that most people just self-insure, they're really not paying a third party to handle the risk of a pandemic, right? Uh, uh, so whatever money you keep for yourself is your insurance, and there's no tax deduction for saving money. So this is a way to combine the best of both worlds by setting up your own insurance company, paying premiums to it, getting a tax deduction for paying the premiums. And then when you don't have enough claims to use all those premiums, if there is excess, then you can take that money back because you own the insurance company. And when you pull it back, you have some options, but assuming you bring it back as income, it's taxable, but it's taxed at a lower rate. It's taxed at the long-term capital gains tax rate. So you can benefit from the higher tax rate going in and pay at a lower tax rate going back out. So that can be really advantageous to dental practices. And there's also a lot of different leverage charitable strategies
Okay.
where, depending on the structure of the group that organizes this, and there's multiple ones that we're familiar with, but taxpayers typically get a 5-to-1 tax deduction on, they invest 50 or 100,000 and they come back with 5 times that on a K1 that shows as a charitable contribution. That's typically in some non-cash asset. It could be land, it could be medical equipment that has a higher market value than what it initially cost. And so you can benefit by participating in a charitable contribution of that asset that's worth more than what you pay for it. So those kinds of things can save people a lot of money. Again, there's risks that the IRS is going to challenge things like that. So we want to make sure we're evaluating it and make sure it's legitimate, first of all, and also understand, even if it is legitimate, do you understand that there's still risk that there's potential challenge coming from the IRS. There's also
Sorry, I just want to say I love the self-insurance because I have seen practices who they took down the road, they added 2 more lanes, and getting in and out of that practice was a nightmare. I've seen that happen. And then dentists have good hearts. They want to help people. That's why they got into the dentistry. And
right.
being able to help them so they can donate something and then have the benefit of a tax write-off on that, especially equipment when they want something newer, that's
Right.
that speaks to so many of their hearts and their souls. So I'm excited about that one too. So that's cool.
Yeah. Yeah, and typically that's not their own equipment. It's other equipment that hasn't been used. It's new equipment that, so it has a high value to it, where
Okay.
they can get those big tax deductions.
Oh, so something like they've had that gathered dust that they didn't use? Is that what you're telling me?
It's typically a third party partnership that has a deal they're putting together, so they already have the equipment, and then
All right.
they're getting partners to invest and participate in the tax deduction. So
Okay, thank
that's how
you.
those work. Yeah.
Gotcha. Gotcha. Sorry, I interrupted you. There was something else you were gonna say. I'm so sorry.
Oh no, no. There's just a lot of different ways to save on tax, and it's not a one size fits all. So when we meet with our clients, we're doing a tax projection, seeing where they're at right now if they don't do anything different, and then looking at options that they can more or less pick or choose from, but through guidance from us. Um, and the key is, and I'm look, I think I'm a good accountant, but I know I'm not the only one too. So you want to make sure that you're meeting with your accountant regularly and looking at all the options available to you.
Awesome. Fantastic. Stephen, if they want to contact you, how could they go about getting a hold of you?
Yeah, I'll shoot my email and my phone number. My email is snance, so S is in Stephen, Nance, Nance, at DrillDownSolution.com. And that's solution singular. There's no S at the end of it, because we are the solution.
Oh, gotcha. Gotcha.
Also my phone number, 801-225-8474. That's 801-225-8474.
Awesome. We will include that in our show notes as well so people can get to it that way. Thank you for being here. It was wonderful having you and enlightening us and sharing your knowledge. I appreciate you. Have a wonderful day.
Thank you so much, Alicia. I really enjoyed talking with you.
Yeah. It's been